CoreWeave just doubled revenue, and it is preparing to spend as much as $13.5 billion in a single quarter to keep growing. Both facts matter, because the CoreWeave story is no longer about whether artificial intelligence demand exists. The real question is whether this company can turn contracts into powered data centers and powered data centers into profits before the financing bill catches up. Today, I'll show you what the quarter proved, why the next few months could be explosive, and the three numbers that decide whether this becomes one of the biggest winners of the AI buildout. Start with the print. Revenue reached $2.575 billion, up 112% year over year and about 24% from the first quarter. Wall Street had expected roughly $2.56 billion, but the cleaner surprise was underneath revenue. Adjusted operating income reached $128 million, above management's prior $30 to $90 million guide. Adjusted operating margin improved from 1% in Q1 to 5% in Q2. Even the GAAP operating margin improved from -7% to -2%. CoreWeave still recorded a $626 million net loss, so this is not a profitable business yet. But Q2 showed something investors needed to see. As new capacity turns on, operating leverage can improve. Now look at demand. Revenue backlog reached $104.2 billion, up 246% year over year. And that figure excludes more than $25 billion of net new customer commitments added in early Q3. That is extraordinary visibility, but it needs one big qualifier. Backlog is not cash and it is not revenue today. CoreWeave says recognition depends on satisfying delivery and service availability requirements. In plain English, a signed contract does not generate revenue until the infrastructure is ready and the customer can use it. That makes power, not demand, the central variable. This is the hinge of the entire investment thesis. CoreWeave may already have more work than it can serve. Now it has to build the machine fast enough to deliver it. Here is how that machine works. First, CoreWeave signs a customer and secures contracted power. At the end of Q2, contracted power was about 3.7 gigawatts. By August 11th, it had reached roughly 4.2. Then CoreWeave has to convert that future power into active data centers, filled with GPUs, networking, cooling, and software. Active power reached 1.5 gigawatts after nearly 500 megawatts of expansion during the quarter. Once that capacity becomes available and customer delivery begins, backlog can turn into revenue. That conversion is why the third quarter outlook is so important. Management guided revenue to between $3.45 and $3.6 billion. At the midpoint, that would be roughly 37% sequential growth. The third quarter adjusted operating income guide is $200 to $260 million. If the midpoint lands, the implied adjusted operating margin would rise again to roughly 6.5%. This is the bull case. Capacity arrives, revenue steps higher, and a larger share of every new dollar reaches operating income. But the growth is not free. CoreWeave deployed $9.352 billion of capital expenditures in Q2, more than 3 times the quarter's revenue. Net interest expense was another $640 million, and management expects the spending to increase. For Q3, CapEx is guided to $11.5 to $13.5 billion. Interest expense is guided to $860 to $940 million. That does not automatically make the strategy bad. If the assets are backed by durable contracts and produce attractive returns for years, heavy investment can create enormous value. But it does make timing unforgiving. If capacity is late, financing costs arrive before revenue. If customer demand changes, CoreWeave still owns the bill. And if operating margin stalls while interest expense climbs, the backlog headline will not protect shareholders. My verdict is bullish on the operating direction, and this quarter made the bull case materially stronger. CoreWeave has the demand, the customers, and a rapidly expanding physical footprint. If it can execute the conversion from contracted power to active power to profitable revenue, it could become one of the defining infrastructure companies of the AI era. But this is not a simple software growth story. It is a leveraged infrastructure race, and the winner will be decided by execution, financing, and time. If you enjoyed this breakdown, leave a like and subscribe to Risk on Capital for more earnings analysis, company deep dives, and long term investment stories.